Chuck and Rick here, your retirement planning authorities. Welcome back to our video blog. Today we'd like to talk to you about investment discipline and market forecasting. You know, the truth is, no matter how intelligent any of us is, what credentials we have, or what experience we have, none of us can predict the future. I wrote a blog recently about market forecasting and how ineffective it really is. The problem is, what do we do with all the worry if we can't forecast the future? Well, what we do is focus on the things we can control, like our costs, our diversification, and our investment discipline. You know, costs and diversification, they're pretty self-explanatory. We keep our expenses low, and we don't put all of our eggs in one basket. But investment discipline, what does that mean to us?
Let's look at a real-life example in our book on page 21 called The Cost of Uninformed Investing. If you look at the first column, it shows that the average investor returned 4.6% on their investment. The second column shows that if you were invested in the S&P 500, you earned just over 8% over that same 20-year period. So, was the average investor in investments that just weren't that good? No. They were in the same investment as the S&P 500. The investor panicked when they heard on the news that the market was going to tank, or they were walking down the street and they saw someone in a suit say things were going to get bad, and they pulled their money out of the marketplace. Same thing applies for the columns on the right. Those are fixed income or bonds. So why does this happen? Let's take a look at our next slide, which is just an excerpt from our book, Overriding Emotions. Whether emotions are good or bad depends a lot on the person and the situation. It's different for everybody. Emotions can make you falsely attached to your high-performing funds and tell you to stay away from the low-performing funds. They cause false hope. They ignore danger. To put it bluntly, they can cause us to act stupidly.
Yeah, I can't tell you how many times I've seen that scenario play out in the real world. You know, imagine this, an investor at the end of the year going through their statements, assessing how their investments did. They look at one mutual fund and this thing just did fantastically, shot the lights out. Probably because that asset class happened to be in favor that year. But regardless, the investor says, this thing is great. I'm going to load up on it. I'm going to buy more of it. I want more of that kind of return. And then they look at their worst performing investments. And they say, what am I doing with this dog? You know, maybe it was just because that asset class didn't have a good year. But nonetheless, they sell it because it's a dog. And when you think about that, what did that investor just do? They just sold low to buy high. The exact opposite of what we know a disciplined investor should do. And that's why we need to leave those emotions off the table. So one of the ways that we do that is through a process called rebalancing. If you take a look at this chart on the screen right now, the Callan periodic table of investment returns, very catchy name, right? The periodic table takes us back to chemistry class, obviously. What this shows us is how the various areas of the stock market around the world have performed over the last 20 years, with the best performer on the top and the worst performer on the bottom. We're going to show you how we can look at this random nature of performance and use that to our advantage next time when we talk about rebalancing. This has been Rick and Chuck. We'll talk to you soon.